Good afternoon. Welcome to Venable. In our program today entitled What's Ahead for 2015, Preparing Your Nonprofit's Group Health Plan for the Employer Mandate. My name is Jeff Tenenbaum, Chair of the Nonprofit Organizations Practice here at the Venable Law Firm. And this program is part of the monthly series that we do every month on a wide array of nonprofit legal topics. In person, for those of you here in the D.C. area, always welcome to join us from noon to 12:30 Eastern Time for lunch. And then we do our program from 12:30 to 2 o'clock Eastern Time. This is, not surprisingly, the second program that we've done on healthcare reform, and I strongly suspect it won't be the last. But we are very fortunate to have, when we planned the program, it was 4 of my colleagues on the panel. Now it's 3 of my colleagues and one recently ex-colleague who has unfortunately moved on, but has graciously agreed to join us for the panel, Chris and I'll introduce our speakers momentarily, but you're definitely privileged to have a really talented panel here today of folks who have been living and breathing healthcare reform for quite a number of months, have been advising many of our nonprofit and for-profit clients, a wide array of employers on compliance in the area, and you're going to benefit from their wisdom here today. First off, a few things, housekeeping matters. This program is eligible for a CAE credit, Certified Association Executive, for those of you who are CAE certified by the American Society of Association Executives. Our upcoming scheduled events, next month, October 21st, our program is entitled Fundraising 201, an update on managing the legal risks of nonprofit fundraising. The first nonprofit legal seminar and webinar we ever did back about 3.5 years ago was on nonprofit fundraising, legal and regulatory issues. It's not surprising that we've come back to that topic, so we're going to take it one step further. It's an area in which we at Venable and our nonprofit practice do a lot of work, and we're also going to have an in-house lawyer from a large international nonprofit organization joining us on the panel as well. And then on November 19th, our program is entitled Enhancing the Nonprofit Governance Model, Legal Pitfalls and Best Practices. It's going to be a really interesting, exciting program that's applicable to every nonprofit out there. And the panel similarly will be comprised of one Venable lawyer and the CEO of a nonprofit here in D.C. with whom we work quite frequently. Our registration for that program will be available soon. In terms of handout materials, those of you in the room have a printed booklet that has a copy of the pretty voluminous PowerPoint slide deck for today's program, along with some ancillary articles and other handout materials and full biographies for all the speakers. Those of you on the phone and the webinar, and we have close to a couple hundred registered for the program here today across the country, you should have received an email that contains the PowerPoint slide deck. All of you tomorrow will receive an email that contains the link to the recording of today's program. That will be posted on Venable's YouTube channel, along with the PowerPoint deck and all of the other handout materials. Feel free to forward that on to colleagues and others who may benefit from that. And all of our recordings of our nonprofit legal programs are available on that YouTube channel I mentioned. The link to that is on the last slide of today's deck. In terms of questions, unfortunately we have a lot of material to cover, so we're not going to be able to take questions throughout, or we won't even come close to getting through the deck, but we will save a bit of time at the end for questions. And those of you on the webinar, post your questions to me using the chat feature on the webcast software. Those of you in the room, just wait for the microphone to come around before asking your questions. Because of the voluminous material we have to cover, I'm not going to take the time, my apologies to our speakers, to go through the highlights of the bios of our speakers. Just to say that Tora Johnson, in order of my right to far right, Tora Johnson, Harry Atlas, Chris Sandelucci, and Todd Horn, all our key members, well, Chris until recently moved on from Venable to a new opportunity at another firm, but all 4 of them work very closely with our nonprofit clients in all aspects of healthcare reform, along with other areas. Tora specializes in nonprofit tax and employee benefits issues. Harry Atlas focuses exclusively on benefit issues. Chris was one of the original architects as a Senate staff member of healthcare reform, is intimately knowledgeable about the Affordable Care Act, and has been instrumental in helping to advise a lot of clients on compliance compliance issues, particularly in the area of exchanges, but in other areas as well. Chris is a member of our legislative group before he moved on to a new opportunity. And Todd Horn, to my far right, is a member of our labor and employment group and does quite extensive work in the area as well. With that, and without any further ado, let's turn it over to Tora to get us started. Tora.
Great. Thanks, everybody, for joining us today. I'm going to start I'm going to skip over the agenda, but basically, to give you a preview, I'm talking about player pay, then we're talking about new reporting. Chris is going to give us some background on the exchanges, and then Todd is going to round off on litigation risks and how to mitigate. So very brief overview and backdrop to the employer mandate, beginning essentially, though, with the first mandate, which is the individual mandate that became effective January 1, 2014 of this year. That's the requirement under the Affordable Care Act that requires all individuals to maintain minimum essential coverage. Minimum essential coverage is the first buzzword that we will dive into in a few slides. Or the individual pays a penalty tax. There are a few exceptions of folks who do not need to maintain minimum essential coverage and can still avoid the penalty, but the vast majority of individuals now need to maintain coverage to avoid paying a penalty on their tax return. Although some individuals will actually qualify for premium subsidy to purchase that coverage on the exchanges now known as the public marketplaces for healthcare exchange, or healthcare coverage. So the employer mandate, very important. It applies to all large employers, for-profits, nonprofits alike. We'll talk about who's a large employer in a few minutes. It was supposed to go into effect as of January 1, 2014, the same time as the individual mandate, but we got very welcome news about 2 July 4th weekends 2 years ago that there'd be a delay until January 1 of 2015. In addition, there are other provisions that allow an additional delay if you operate your health plan on a non-calendar year. So if you have a fiscal year health plan, it may be possible to avoid the employer mandate until your first day of your plan year in 2015, but those are very complicated transitional rules, and if anyone thinks they may qualify for it, I would advise a careful review of those provisions and then doing some documentation of the reasons of why you think you fit into that exception and transitional rule in case you are ever asked to explain it to the Internal Revenue Service. So what is the employer mandate? It imposes a mandate on large employers to offer minimum essential coverage to their full-time employees and their dependent children up to age 26 or pay a penalty tax. So large employers could decide, not going to offer coverage, I'll pay the penalty tax. In addition, there's another layer of penalties that even if you offer minimum essential coverage, you have to make that coverage both affordable and it has to provide minimum value to avoid a second penalty. So not only, the first penalty is you got to get an offer of coverage out there to your full-time employees and to their dependent children. Then in addition, you need to make sure it is affordable and minimum value. And we're going to unpack what each of those terms mean in just a moment. So who's a large employer? A large employer is defined as an employer that employed on average at least 50 full-time employees, including full-time equivalent employees, on business days during the preceding calendar year. So you add up your full-time employees, and we'll talk about how you define full-time in just a moment, and you add up all your part-time employees and see if you get to 50. Although I will note for 2015 there's a special transitional rule, so you do not need to comply even if you got to the 50, but if you're less than 100, then you have another year until you need to comply. Again, these transitional rules have bells and whistles with them, so if you think you're within that sweet spot, it's time to crack the regulations and the preamble and to make sure that you actually squarely fit within that transition rule. And when you're counting, the Affordable Care Act is full of new math, and when you're counting to 50 under this new math, You need to look across your control group. So if you have related corporations and you have a similar parent that appoints the boards of more than one corporation, you need to ask yourself, you need to look at the 50 across that control group and make sure that you're taking into account all those full-time employees across the control group and the part-time people across that control group. And when you're looking at full-time, you're looking at averaging 30 hours a week or 130 hours over the month. And we'll look at that a little bit more too. And you're looking at the common law test. So you might have employees out there that you have categorized as 1099 as independent contractors. But you need to, that's always a hot button issue, and it's more so now that you need to make sure that they are truly independent contractors and not your common law employees. If you are telling them how to do their job and when to report and meet the common law definition of employer, then they're going to add into counting to 50. So, a penalty tax is due for any month in which at least one full-time employee is certified to the employer as having purchased subsidized coverage on these new marketplace exchanges. And the trick, however, is that an individual isn't going to be eligible for a premium subsidy and therefore can't trigger the penalty to the employer if they've been offered coverage from their employer, and that offer of coverage has been both affordable and minimum value. And we'll see how that works when we go into a little bit more detail on the penalties. So the first penalty is the one that I'll spend the most time on. It's the no coverage penalty. It's in 4980HA of the Internal Revenue Code. I've heard a regulator say that this first penalty is under A because it's A for awful. It's the worst of the two penalties. The additional penalty looks like a walk in the park in comparison to this A awful penalty. So this is the one where if an employer, nonprofit, for-profit, that's large, at least 50 employees, including those part-timers, if that employer fails to offer coverage to more than 5% of its full-time employees, and even one of those full-time employees that wasn't offered coverage goes to an exchange and obtains subsidized coverage, then the penalty is triggered. Now, it has to be an offer of coverage to full-time employees that includes children up to age 26. Doesn't have to include spouses. What's more, it's just an offer of coverage. It doesn't matter whether or not the employee actually accepts coverage. You just need to get the offer out there. And for 2015, it's a 30% margin here, not a 5%. It's a very nice transitional rule with not a lot of bells and whistles to it. So for 2015, you can get your systems in place, and they said you just need to make sure you're covering at least 70% of your full-time employees. Will quickly jump to 95% in 2016. And there's a lurking B penalty, even if you're within the 30% next year and then the 5% the years thereafter that we need to talk about. But this A awful penalty will be avoided if you're hitting at least 70% of your full-timers next year. So the annual penalty is $2,000, but it's actually assessed on a monthly basis. So you're going to look to see whether you pass the test month after month. But if you fail for the entire year, you would be paying $2,000 times your total number of full-time employees. Although you do get a slight discount, you get to discount and disregard your first 30 full-timers in 2016 and the years thereafter. Another special transitional rule in 2015, you can discount your first 80. But this is the awful penalty because if you trigger it, you are paying it on your entire full-time population, including those that you offered coverage to, minus the first 80, then soon to be 30 full-time employees. So you could be getting an offer of coverage out to the vast majority of your employees, but if you fail to reach that 70% or that 95% threshold in in 2015 and one of those full-timers goes and gets subsidized coverage on the exchange, you will not only be paying health care coverage for the majority of your employees, but paying this tax, which escalates very quickly. So what I haven't paused for a moment is to say who is eligible for a subsidy on the exchange. So for an individual, it's largely income-based, and for an individual, it's an individual making up to about $45,000, and for a family of four, about $92,000. So a vast majority of employees will actually be eligible on the income basis for subsidy. If you are in a control group, so you have related nonprofits, and one of them triggers the penalty, the good news here is that the penalty is just assessed on corporation by corporation. So while you count to 50 to see whether you're a large employer across your control group, if you trigger the penalty, it's just on that employing corporation, which is good news. So,
Tori, let me mention one thing on this no coverage penalty, because I get this question a lot. This $2,000 penalty, right? That's the dollar amount. Well, interestingly, the statute actually indexes the $2,000, and it's not your normal index. You know, oftentimes a number in the Internal Revenue Code is indexed to, let's say, CPI, which is oftentimes a 1%, 2% type of increase. This penalty is indexed to the increase in premium year after year based on a 2013 benchmark premium price. So what I mean when I say that is, so let's say in 2016, the premiums are 10% greater than they were in 2013. The $2,000 penalty is indexed by 10%, as opposed to, again, the typical 1 or 2 year after year index to CPI. So it's important that folks understand that the penalty is even higher than 2,000 and will index exponentially as we move further into the decade and premiums increase to a greater degree as compared to 2013.
Thanks, Chris. So who's full-time? I mentioned very briefly, it's an individual who averages at least 30 hours of service a week or 130 hours over a month. It's the first time the government has come in and told you who full-time is for health care coverage. It used to be that employers had discretion, and you still do, although you'd run the risk of paying these penalties, and you wouldn't want to do that unwittingly. And so what is an hour of service? An hour of service is time for which the employee has worked and is being paid, and then it's unpaid time, such as jury duty, vacation, paid leaves of absence. And it's important that you take this definition and look at your payroll system and making sure that they are synced so that you're counting hours appropriately. Then there are two methods for doing the calculation and looking at if someone who's averaging the 30 hours or the 130 over the month. The first is the monthly measurement period, or the monthly measurement method, and the second is the look-back measurement method. And I'll talk a little bit about each and which type of employer would benefit by each method. The monthly measurement method, when you're looking at ongoing employees, so employees already in the door, you need to determine whether somebody is full-time. You look back. So you come to the end of September, beginning of October, and you say, okay, did this employee work on average 30 hours a week or 130 over the month? And there's no margin of error. They either did or they didn't. And if they did, you want to make sure, you better hope that you've gotten out that offer of coverage. There's no correction under the monthly measurement. You simply look back. It's more of a calculating tool than a prediction. And you want to make sure that if you're using this method, that you're pretty good at ascertaining who's going to be full-time and you're getting those offers of coverage out. Because again, in 2015, you've got a little bit of breathing room. You've got a 30% margin of error, but quickly thereafter that reduces to 5%. For new hires, you got to offer somebody that you expect to be working full-time hours coverage no later than the first day of the first calendar month, immediately following 3 full months of employment, which is a mouthful. Essentially, my example was if you were hired June 15th, you've got all the remainder of June, all of July, August, and September. They get an offer of coverage out, except you really don't, because there's another provision under the Affordable Care Act that applies whether or not you're a large employer that says when somebody's eligible, you got to get that offer of coverage out to them, and they need to have coverage effective as of their 91st day from that date of hire. And the penalty for failing to do that is $100 a day per affected individual, so that can add up quite quickly. Then moving on, so the look back, the monthly measurement, again, is very simple in its rules, but again, you're just looking back and making sure that you met the requirements. You can't fix it if you get to the beginning of the next month and you're looking back and you haven't gotten enough offers of coverage out. So in answer to employers' requests for some sort of safe harbor and cushion, we were given the look-back measurement method, and once I get to the end of it, you'll query and wonder whether it is such the desired outcome and result, but here goes. So it's essentially a safe harbor, and what you do is you get to measure your employees' hours over a period of time known as the measuring period. You come to the end of the measuring period, which is going to be somewhere between 3 to 12 months, although I think most employers are going to end up with a 12-month measuring period. You come to the end of 12 months, you're in an administrative period. You can look back over the person's hours over the measuring period and say, okay, did they average the 30 hours? If they did, then they get a offer of coverage for a corresponding stability period. So if your measuring period was 12 months, then they get an offer of coverage for a 12-month stability period. So you're disassociating when the employee worked the hours and when their offer of coverage is given. And I'm going to skip over the next slides, just definitions of measuring period, administrative period, stability period. And then here's a graphic to see how it looks. And this is for folks who are in the door today, your ongoing employees. And I'm backing into a January 1, 2015 plan year, which would be your first stability period. And if you were going to use a year measurement period, you could be looking from November of 2013 to the end of October of this year. So you would look back over that standard measurement period and say, did everybody average 30 hours a week, 130 a month? When you do look at that during the administrative period, which you would like to correspond with your open enrollment, do the calculations, get the offers of coverage out, and the stability period is your plan year. Now, if people don't have data that reaches all the way back to November of 2013, there are transitional rules that would allow a shorter measuring period going into 2015. The normal rule is your measurement period and your stability period have to be more or less of equal length. There's some nuance in all of that, but definitely going into 2015, you can have a shorter measuring period, even though you're going to have a year-long stability period in 2015. And you will see as soon as you end your first standard measurement period, you're going to start your second. So you are always in a measuring mode, looking for coverage for the next plan year. And that's the easy part of the look-back measurement method. You have to layer in new hires. If you reasonably expect somebody to work 30 hours or more when you hire them, then they're considered full-time and you need to get them an offer of coverage out. Everybody else, it's a new vocabulary word, is a variable hour employee. So in there would be part-time employees, now meaning those folks that you expect to work on a reasonable basis, less than 30 hours a month. And you can also fold into this group of variable hour seasonal employees. Even if you hire them and you think they're going to work the 30 hours, if they're truly seasonal employees, meaning that their employment is going to last less than 6 months and they're tied to a season, the lifeguards, the ski instructors, you may know that they're going to work more than 30 hours, but the rules will say you can treat them as a variable hour and you can put them into this testing measurement regime, and you don't need to get them out an offer of coverage like you would any other full-time employee that you hire. So on the new hires, you've got to get their offer of coverage out. It's the same mouthful. First day of the first calendar month immediately following 3 full months of employment, again with the same caveat that you got to make sure you're complying with the 90-day limit on waiting periods. Then with the new hire variable, the new hire that you don't know that they're going to work the 30 hours or more, they will have their own initial measuring period that's targeted from their date of hire. Although the government has said if you hired 365 days a year, you would be running initial measuring periods each and every day, which would be insanity. And the best I can do is reduce that to 12 times, because what the government has said is you can push people who are hired in a month to the first of the following month to start measuring their hours. So all of your September hires you can start measuring in October. But you need to pick them up also in their first year of hire. Not only do they have their own unique initial measuring period based on the first of the month after their date of hire, they need to go into your next standard measurement period that you are using for all of your already onboarded employees. And you look at the test results of both of those. So in the light blue, that's their own unique new hire, hired in the middle of the month. So that counts as part of your administrative period. At most you can have is 90 days. So you do have to discount if you push to the first of the following month. It reduces your administrative period when you get to look back at hours. But you can do it for new hires because you're not going to have that many of them in a month, hopefully. Then they have their initial measuring period. You look back during the second part of your administrative period, and then they have an initial stability period that is triggered off of after the end of their own initial measuring period. And I realize that this is Greek, and so hopefully the graphic is helping. But you're also, so if they tested full-time during their initial measuring period, then they have an offer of coverage for their initial stability period. Even if when you pick them up in their standard measurement period for the entire plan, if that person did not test full-time, weren't averaging the 30 hours over the standard measurement period, they wouldn't need an offer of coverage for the dark blue stability period, which is going to be your plan year, except for the fact that they do have that offer of coverage based on their own initial measuring period, and you do need to honor that. So they get the better of the two results that first year. It's very much like 401k plan testing for new hires. The look-back measurement period is complicated, and I'm not going to go into this, but that generally speaking, if you have a change in employment, so you hired somebody and they were full-time, they were part-time, and you are testing their hours under this method, then the fact that they change employment status doesn't necessarily mean that they get an offer of coverage from you. Their hours are reflected in their measurement period and will help determine whether or not they get an offer of coverage for the next plan year. There are also special rules about unpaid leaves of absence, such as FMLA leaves, where you aren't going to penalize somebody who's taken a protected leave. You essentially don't count the 0 hours when they're on leave against them. There are also special rules for rehire, when you can put somebody back into a testing regime or when they need to be put back in coverage if they had tested full-time. So if you have somebody who tested full-time, they're in a stability period, you're offering them coverage, they then terminate. If they're rehired by you within 13 weeks, they need to be offered coverage again when they return as a full-time employee. They get to ride out the rest of their stability period. Now, if they're rehired outside of the 13 weeks, you can treat them as a new hire, and if they are variable hour, meaning you don't reasonably expect they're going to work the 30 hours a week, then you can test them again, a testing regime. The government is also very prescriptive about when you can use these different measurement methods, and they allow you to distinguish between employees and employed by different corporations within your control group, salaried and hourly, employees in different states, collectively bargained. But other than that, they don't let you mix and match. So when you're looking at what method to use, you need to keep these categories in mind and realize that there are boundaries about who you can put in the look back and who you can put in the monthly measurement. So what type of employer should be looking at the monthly measurement? Again, it's not a planning tool, it's really a calculation tool. There's a little margin of error, so it's best for folks who have very steady hours. You know what your employees' hours are going to be, so that you can live within the zone, the 30% margin of error, the 5% margin of error. The look-back measurement method, there's some employers that are just going to need it if they have a lot of on-call per diem. So if your hospitals are out there, these are the folks that are going to be looking at this look-back measurement period. Also, if you have a lot of seasonal folks that you do not typically extend coverage to, you're going to want to look at the look-back measurement method. Hopefully these groups of folks are in your hourly bucket, so you could use look-back for them, and then your salaries, you could use the monthly measurement period. So that was the awful penalty. This one is a piece of cake, and I won't spend long on it. It's the unaffordability penalty. It is always lurking, though. I wish I could come up with a word that begins with B that was like lurking, because even if you have avoided the A penalty because you're within that 30% margin of error, 5% margin of error after 2015, you can be subject to this penalty. This is the penalty if the offer of coverage you give your employees is unaffordable or doesn't meet minimum value, and that employee goes to an exchange and gets subsidized coverage. The V penalty is triggered. Now, it's $3,000 a year, so on its face it seems higher than the $2,000, but actually there's no multiplier. You only pay it on the employee, the full-time employee who goes and gets subsidized coverage. So in that sense, it's not as awful because you're not looking at multiplying it across your entire full-time population. So then let's figure out what the terminology means, and I'm going to handle minimum value first because that's the easiest. Most employer plans today offer minimum value, and the way you can make sure that your plan offers minimum value, you can go to a safe harbor plan design, or you may already be there. You can go to a calculator that the government has established, and or you can go to an actuary if the first two methods don't work. Unless you are moving to something called a basic plan or a skinny plan and you're really carving back what you're giving, you're going to meet minimum value without an issue, and you can also go to your broker and say, look, can you just tell me that we have meant it here? Then the affordability is the harder issue. Now, affordability means that the premium an individual pays for your lowest cost option has to be affordable. Doesn't matter if you have to offer dependent coverage to kids to make sure you avoid the A awful penalty, but there's no requirement that that be affordable, and there's no requirement that you offer spousal coverage or that spousal coverage be affordable. You're just looking at how much the individual pays for your individual-only coverage under your least expensive option, and that can't be more than 9.5% of the employee's income. And it's household income, which you won't know, so the government says, okay, so they're safe harbors. You can use W-2 that they receive from you, Box 1 W-2 paid wages. Again, that's not very predictive. You can look at last year's W-2 wages and sort of predict for the next year, but if it's volatile, that's not going to work. So if you have an hourly workforce with hours that change, you might want to look at the rate of pay, which gives you a formula. It's 9.5% times their rate of pay, assuming they work 130 hours a month. Or you can peg it to the federal poverty limit. The individual premium for self-only coverage can be limited to 9.5% of the federal poverty limit, which means an annual premium of about $1,100, which is hard to do unless you have a high deductible health plan, which some employers do, with zero employee contribution or very low employee contribution. So there are a lot of factors in determining whether an employer triggers the penalty, either the awful penalty, the no coverage, or this unaffordability. And you may be asking yourself, how is the government collecting the data? And that is what Harry's going to talk about next, is their new reporting regime that all employers are going to be subject to help with that process.
Thank you, Tora. So you all have heard a lot about the employer coverage mandate, and Chris is going to talk to you about how individuals interact with the exchanges. My topic is really the bridge between those two sections. And just to recap, the basic structure, the big picture structure is that if an individual is offered affordable minimum value coverage, they're not eligible for a subsidy on the exchange. If they're not offered that, they are eligible for a subsidy. And if the people go to the exchange, and get coverage, then there's a penalty. That's what we just heard about. The burden in connecting all those dots is on the employer through the new reporting requirements to encapsulate all of that information, all that complex information, and report it to the IRS. And that's what we're going to talk about. Just as a basic overview, there are two sets of reporting requirements. One of them is really focused on letting the IRS know which individuals have obtained the required coverage to avoid the individual mandate penalty. And the other is focused on employers and ensuring that the employers have complied with the employer mandate requirements. Today we're going to focus on the latter, which is the reporting requirements that apply to employers. All of the discussion that you just heard as far as the employer mandate is all encapsulated into these reporting requirements. So for example, if you open up the forms and then the instructions and they talk about fill out this section for your full-time employees, which sounds like a pretty innocuous instruction, that incorporates all of that discussion that you just heard. So determining who is a full-time employee for purposes of the reporting form incorporates the entire discussion about monthly measurement and look-back periods. So it's all baked in there. If your nonprofit entity has affiliates, if you have affiliates that have common board control, or if you have for-profit subsidiaries, you're a control group. And as a control group, each entity within the control group has to report on its own employees. However, there also is an accounting for control group members, so you'll have to list your control group members in these reports. Right now, the IRS has issued draft forms and draft instructions. And the basic structure, we can think of the W-2 system as an analogy. It's different, but the concept is similar in that each employee is going to get a form, and that's going to be the Form 1095-C that will be provided to each employee. And then the employer aggregates the data on those forms and reports it to the IRS using a Form 1094-C. And Tora mentioned that for 2015, if you're between 50 and 100 employees, you have an exemption from the mandate. That does not apply for reporting. So if you're between 50 and 100 employees, you're required to report for 2015. We included a copy of the form in your booklet so you can take a look at it. The form on the screen now is the Form 1095-C. That's the form that's going to have to be filled out for each employee. And let's talk about some of the detail that goes in there. You start with the basic demographic information, the employer, the contact information, the calendar year. But then you're going to have to account for your full-time employees. You're going to have to account for all the detail that's going to be necessary to determine whether there's a penalty involved, which means, did you make an offer of coverage to the full-time employee and their dependents? Was it minimum essential coverage? And because the penalty is calculated on a month-by-month basis, if there's variance between months, you have to report each month separately. For each full-time employee, you also have to report cost-sharing information. All those elements that go into the calculus of whether a penalty is due are going to all have to be reported. And if you have a self-funded plan, the reporting is even more detailed, because if you're in an insured plan, your insurance company is going to be doing some reporting to enable the IRS to determine whether individuals themselves have coverage sufficient to satisfy their individual obligations. If you're a self-funded plan, you don't have an insurance company doing that reporting, and the burden will fall on you to report not only your employees, but also their covered dependents, including their Social Security numbers and the like. Really, all the information that the IRS is going to need to be able to go person by person and determine whether each individual has coverage that exempts them from the individual mandate. So there's really just a ton of information that has to be gathered in order to comply with the 1095-C. It has to be provided to employees each year, January 31st, and in addition, it has to be provided by mail unless your employee has affirmatively consented to electronic delivery. If you're relatively small, that may not be too big of a deal, but for larger nonprofit organizations, that could be a significant mailing cost. So that's something to think about, because the need to get affirmative consent in order to have electronic delivery is burdensome, and oftentimes affirmative consent is hard to get. So you're likely going to be mailing this form to people. There are several alternative reporting methods which the IRS has included for, just to overgeneralize, and then we'll talk about some of the details. But if you're very generous and expansive in how you provide coverage, the theory is that you should be absolved from the need to report some of this detail if it's really superfluous, because you cover almost everybody, or you provide it at a low cost. That's the general theory. But when you get into the specifics, it's really, I think these are going to be hard to satisfy for most plans. But the first concept is the concept of a qualifying offer. And this is an offer which is made for all months in the calendar year. You make an offer of coverage. It's a minimum value. As Tor mentioned, most plans will meet minimum value. But then the employee cost of employee-only coverage cannot exceed 9.5% of the federal poverty level. So this is really probably the most difficult cost safe harbor to meet. You can't charge the employee its index for this year. It's more than $1,108.65 for the year. So if you're charging your employee more than that for employee-only coverage, you won't qualify for the safe harbor. And you also have to offer coverage to dependents and spouses, even though generally you don't have to offer spousal coverage for mandate purposes, but to qualify for this reporting simplification rule, you have to offer coverage to spouses. And there's codes in the reporting that are used if you make a qualifying offer. You can skip some of the details and just put a code in to show that you've met that. It's also, and then the employee gets a simplified statement. So the theory is that you're being alleviated of some of your burden. Whether that works out for most plans has yet to be seen. There's a special rule for 2015 only that if you make qualifying offers to 95% of your population, then there's a further simplification in the reporting that you can give to your employees. But that's for 2015 only. The second alternative reporting method are the so-called 98% offers. And this is, if you offer at least 98% of your employees who are full-time employees at any time during the year, you offer them affordable minimum value coverage, you can exempt yourself from some of the detailed reporting. But again, you have to make the offer to 98%, and you have to keep track of it to support your claim of exemption. And many employers are going to find that they simply don't meet that, or that it's simpler just to report using the regular method for everybody. The next IRS form, which we have a copy of, what we've discussed so far is the employee by employee form, the 1095-C. This is the 1094-C. This is the form which employers use to aggregate data and report on an aggregated level. And this is essentially what you're doing here is you're self-reporting whether you owe these penalties. You can, an employer can have multiple 1094-C forms. If it wants to use multiple 1094-C forms for some reason, it has to designate one as being the overall aggregation, the authoritative transmittal, which captures all information and is designated as such. And as you look through the form, what it really is doing is it's making you show whether you have offered a sufficient percentage of your full-time employees coverage sufficient to avoid the A penalty. You have to report that. And then in addition, you have to list the names and employer identification numbers of all of your affiliates, all of your control group members. And there's a place for that. So if you have a relatively simple structure, that shouldn't be too much of an issue. We deal with a lot of clients that have complex structures, and they have some uncertainty about whether certain entities are affiliated or not under these complicated affiliation rules. This is really one time, I think a fairly unique time, where the government's actually requiring you to take a position on everything and to write it out, include a name and a taxpayer identification number to your affiliation. For these forms, you have a little bit more time to complete them. They have to be filed by March 31st of the following year. If you're an electronic filer, which if you have more than 250 employees, you have to file electronically, or otherwise by February 28th if you're filing on paper. And the regular IRS penalties for incorrect or incomplete returns apply, which is $100 per return and $100 per participant statement. So there's a lot in the informational reporting. It's important for anybody who's subject to the employer mandate to review these as soon as possible to make sure that you're accumulating the data and that you're going to be able to comply, and if you're thinking of outsourcing it, to identify who would be responsible for it and how that would be put into effect. I'll turn it over to Chris.
All right, thank you. And as you can tell,
Chris, hold on.
Sure.
Before you go on, Tora wanted to address a question that we've gotten from a number of people on the telephone.
So people have been asking, what do I need to do if I'm less than 50? Well, the first thing you need to do is really make sure you are less than 50. You've got the control group issue. You also have to count part-time hours. So once you've done the new math and you're under 50, then we could do a whole other seminar on sort of the market reforms that aren't new and aren't changing per se for 2015, but are you offering coverage to kids up to 26? Are you maintaining what's known as grandfathered status so that you do not need to comply with certain market reforms, which would include first dollar preventive care for in-network? Also, it would be free access to OBGYN if you are not grandfathered. There are a host of reforms, but none of them are all that new for 2015. The only one that comes readily, I will tell you, and if you're not grandfathered, then there are new rights that you have when a participant is appealing a denial. The one thing that I can think of off the top of my head for 2015, which is new, is if you are not grandfathered, you need to start covering as preventive care for your first plan year on or after September 23rd of this year, certain breast cancer prevention drugs at no cost. Chris, can you think of anything else on the small?
Not really. From a reporting perspective, Harry indicated that there is not an exemption if you're under, or I should say if you're between 50 and 99, which actually has the 1-year delay of the employer mandate penalties. You don't have that same exemption for the reporting. One almost simplified way of reporting if you're between 50 and 99 is there is a box, and correct me if I'm wrong, there is simply a box on the form that you can check to say, hey, I'm attesting that I'm between 50 and 99, so as a general matter, you don't have to run through all the same detail that's in the reporting that Harry went over, but that's the only kind of difference I could say of somebody between 50 and 99. Now, I know the question was 50 and below.
Right. So I'm definitely happy to entertain questions about that offline for people who are interested in the under 50.
And I'm going to kind of shift gears and hopefully, obviously the employer mandate rules are extremely complex. I would argue that the reporting requirements that Harry ran through are even more complex. and certainly burdensome. So definitely come talk to these guys and talk to folks when you have to really figure out what systems you need to put into place in order to comply. Now, my section is, I'm going to really focus on interactions between an employer, a nonprofit, and an exchange. Now, as Tora indicated, to be subject to the employer mandate, you have to be 50 and above. To trigger the penalty, one of your full-time employees has to actually access the subsidy. Now, to kind of repeat what was discussed, there is a general rule when it comes to who is eligible for a subsidy. And the general rule, and again, this is repetitious, but as I always say, repetition is good, as my friend Katie Spangler said, consistency is good. So when it comes to who is eligible for the subsidy, which again triggers the penalty under the employer mandate, if an individual is getting an offer of coverage, then as a general matter, they are not eligible for a subsidy. Now there's an exception to that rule, which Tora went into excruciating detail, which is?
You just need to be closer to maybe that one.
Hold the pod closer.
That one.
I will surround myself with the microphone.
Sorry, my apologies to those of you on the phone. Our usual audio equipment is malfunctioning today, so we have kind of our backup system, which is a little less than ideal, but from what I understand, at least it's functioning, and you should be able to hear.
And I oftentimes talk loud, so now that I bring these closer, don't mind me. So back to the repetition and the rule. If you're offered coverage, not eligible for the subsidy, so therefore someone's not going to trigger the penalty. Well, there's exceptions to that rule, which Tora went through, which is if that offer happens to be unaffordable or that offer happens to not provide minimum value, well then, a person is eligible for the subsidy. So as I like to give examples is, let's say I'm a nonprofit or I'm a for-profit employer, and I employ folks and I pay them $200,000, each of them $200,000. Well, as Tora indicated, to be eligible for the subsidy, it's also based on income. So my employees aren't going to be eligible for a subsidy regardless of whether I offer them coverage or whether my coverage is affordable or provides minimum value, because they're not eligible based on income. So I, as an employer, am never going to be subject to the employer mandate because none of my employees are ever going to get a subsidy. That's an extreme example. Certainly in most even for-profit, but certainly the nonprofit world, is there are folks that are being employed and offered income that is within the income eligibility realm, and therefore nonprofits as well as for-profit companies in this area have to be concerned about whether someone's going to be eligible for a subsidy. And again, it goes back to the exceptions. Are you offering? If you are offering unaffordable minimum value. So let's just say your plan is unaffordable. Well, how does an individual employee actually enroll in an exchange and actually get a subsidy? And let me pause for a moment to say this. I'm focusing right now on the individual marketplace. As we all know, there are two types of exchanges, i.e. two types of marketplaces, regardless of how you want to refer to them. I'm going to refer to them as exchanges right now, okay? There are two types of exchanges. Exchanges for the individuals. There's exchanges for small employers. Many of the nonprofits in the room as well as on the phone are likely under 50, so you are a small employer, and thus you might be getting your coverage through the small employer exchange, the shop exchange, especially if you're here in D.C. I'm not going to talk about the shop exchange. What I'm referring to right now is the individual exchange. And it is the individual exchange where one of your employees can actually get coverage and access the subsidy. So what's the enrollment process for this individual exchange? Well, there's open enrollment periods. There's only certain windows of time over which an employee can actually enroll in a plan through the exchange and therefore access the subsidy, which then triggers the penalty for you. And for the 2015 open enrollment period coming up. That open enrollment period is very small, actually. It's a tight window. It's November 15th to February 15th. So there could be an instance where one of your employees who you're either not offering coverage to, or you're offering coverage and that's unaffordable, they don't even enroll in a plan because they miss the open enrollment period. However, as I believe is on, I'm not seeing with my glasses because we on the special enrollment, here we go. There is an exception to what I just described with regard to the open enrollment window, is HHS has created, or Congress, and then HHS through regulations, has created special enrollment periods, certain periods during which an individual can actually enroll in coverage. And these special enrollment periods are very similar to, let's say, the group plan special enrollment rights under HIPAA. You know, if you have a kid or if you get married, those are those trigger in a special enrollment period. But there are additional special enrollment periods. And one of the special enrollment periods is an individual actually becomes eligible for a subsidy. Well, how does somebody become eligible for a subsidy? Well, they're either not offered coverage because their employer dropped it, or their coverage happens to be unaffordable or doesn't provide minimum value. So there are windows that an employee of yours who is income eligible could be eligible for a subsidy, enroll in a plan, and thus trigger the penalty for you, provided you're subject to the employer mandate. Now, how does one enroll in this individual exchange? Well, let me just take the federal exchange for a moment, because the federal exchange is in about, 36, 34 states. I always lose track in truth. And the enrollment process is fairly straightforward. The federal exchange has a public-facing website called healthcare.gov, which I'm sure a lot of people have heard. Let's flip to the next slide if you need some time. There's another avenue, what's called a web broker entity. And a web broker entity is actually a company, a for-profit company, also putting up a public-facing website to accept consumers to enroll in a health plan. And these web broker entities actually serve as a proxy for the federal exchange, for example. Now, why do I mention this web broker entity for a moment? And the reason is this. There are a number of employers out there that are starting to take a holistic approach to offering health insurance. As Tora indicated, you're subject to the employer mandate, and you have to offer coverage to a full-time employee. Well, you might have people who are part-time, who work below the magic 30 hours a week. You might have seasonal employees that you don't have to offer coverage to per the employer mandate rules. Well, some employers still want to offer them coverage, or at least, let's say, make sure they get health insurance. Many employers are saying, well, I'm not going to offer them coverage because the law as a general matter doesn't require me to, but I still want them to have insurance. So some employers are looking to these web broker entities as a trusted advisor, as a trusted resource for these part-time, these seasonal employees to actually get coverage and enroll in the individual exchange. Now again, that discussion is separate and apart from the employer mandate discussion, but I did want to give you a sense of why I mentioned this, maybe this new term, because I know that a lot of folks out there that I speak to aren't as familiar with these web broker entities. Now, let me shift gears to just say this. There is an interaction between the employer, the nonprofit, and the exchange, and those nonprofits that are actually subject to the employer mandate. And how does this interaction work? Well, as I indicated, an employee has to go to the exchange, buy a plan, and access the subsidy. Well, there is actually a verification process that the exchange is, an obligation that the exchange is under. And that is, they have to make sure that the employee who is coming to them is telling the truth. So they have to make sure that that plan is actually unaffordable. So I give this example. You know, I'm an employee of Venable, or I was an employee of Venable. I'm just an employee, right? And I go to the exchange and I go, hey, exchange, my plan is unaffordable to me. Therefore, I am eligible for a subsidy. The exchange has to say to me, are you covered by an employer plan? I will say yes, because I am an employee. They will then say to me, is your plan unaffordable, or does it provide minimum value? I'm going to likely say, I have no idea. The exchange actually has to verify whether the plan is affordable and minimum value. And actually, there are regulations governing what an exchange has to do to verify. The first step is the exchange is required to access an electronic data source. Well, we don't know what this electronic data source is or means, because there isn't one right now. There might be one in the future, and for administrative ease, it's advisable that the employer community work with the exchanges or with the Department of HHS to get some sort of electronic data source, but right now there isn't one. So there's a couple other steps that an exchange has to go through to verify. The last step being, or at least one of the last steps being, they have to contact the employer directly. Say, hey, Chris is your employee. He came to me saying that his plan was unaffordable and therefore he's eligible for subsidy. Is he telling the truth? And the employer has the opportunity to respond. Let's say the employer doesn't respond. The exchange, by the regs, by the rules, has to give me a subsidy. And guess what that does? That triggers the employer mandate. So then the IRS comes knocking at your door and sends you a notice. It says, hey, Chris just got a subsidy. Guess what? You are subject to an employer mandate penalty. Fork it over. Well, I, as the employer, might see that notice and go, well, shoot, my plan was affordable. I offered Chris an affordable plan. So I actually have a second bite at the apple as the employer, as the nonprofit. I can actually go back to the IRS through an appeals process under the employer mandate rules and say, no, I actually offered Chris an affordable plan. And if I provide that information, the IRS will say, why, yes, you did, employer. You did offer Chris an affordable minimum value plan, and therefore you are not subject to a penalty. So there is this interaction with the exchange, and then there will be some interaction with the IRS in the unlikely event you do not respond to the exchange when they come knocking at your door for certain information. And when it comes to this appeals process, this is a good segue into Todd's portion of the presentation to talk about appeals and what it means when it comes to potential employee-employer litigation in and around the employer mandate.
Hello, everybody. Let me get something on the table right now. Unlike my colleagues, I am not a benefits attorney, okay? I am an employment attorney. I help my clients avoid getting sued by their employees, and I represent them in court when they are sued. Now, everything you've heard so far deals with the aspects of the Affordable Care Act that are very polite, very tidy, very civilized. I am going to talk about its gruesome secrets, okay? Secrets that you may not know about, because believe it or not, embedded within this law are booby traps and tripwires that your employees are going to be salivating over to potentially sue you. So I'm going to show you where some of them are. So imagine, if you will, one of your employees is having some performance problems, receives a negative evaluation, and you put them on a performance improvement plan. That employee tells their supervisor that your health plan is not good enough under Obamacare. Thereafter, the employee fails the PIP and is terminated. Is there a problem? We'll see. Imagine, if you will, you have several employees who generally work only 35 hours a week. And remember, that's enough to get coverage. You reduce their hours to 29 because you don't want to pay for the coverage. And if they're part-time under 30, you don't have to pay, right? So you cut their hours. Is that a problem? We'll see. You have several individuals who work for you as independent contractors. Okay? One of them complains that you micromanage them. And as a result, they're really an employee. And as an employee, they should be allowed to participate in your plan, but you're not letting them. After this, you terminate the relationship with them. Is that a problem? You know what I'm going to say, okay? I'm going to discuss two laws that create risks for you under these and a lot of other scenarios. The first one is the Fair Labor Standards Act, okay? And I know what you're saying. You're saying, Todd, you don't know what you're talking about. The Fair Labor Standards Act is that 100-year-old law that deals with minimum wage and overtime obligations that nonprofits and other employers have. It has nothing to do with the Affordable Care Act. But remember, folks, we're talking about hidden risks, and the FLSA is one of them. Unknown to many, the Affordable Care Act amended the Fair Labor Standards Act, and within the amendments, it added a very broad anti-retaliation provision that protects your employees. It also added a very broad and very deep whistleblower provision that covers employees. It also gave employees the opportunity to sue their employers and gave very expansive remedies if they succeed. You all want to see the law? I brought it with me. You ready? There it is. This is it. For those of you listening remotely, I'm holding a piece of paper that's about as big as a dollar bill. It's tiny. But do not be lulled into a sense of security by this adorable law, because it is extremely evil for purposes of compliance. It has huge potential penalties and huge compliance obligations. So let's look at some of its dangers. Okay, the whistleblower and anti-retaliation provisions of the law have two aspects. Number one, what is protected activity? What does an employee do to become protected? And number two is what retaliation is prohibited? What can a nonprofit do that can get it in trouble? So first, let's talk about protected activity, and there are three types. The first type of protected activity is called participation, and this prohibits retaliation against an employee who participates in a proceeding involving the Affordable Care Act, and that could be they testified, they or act as a witness, and they do that and they're protected. And you can see it also protects folks who not only participate, but potentially participate because they're about to. Okay? Very broad coverage. The second aspect of protected activity is huge. This is the complaints. This protects employees against retaliation because they have either provided information or are about to provide information to an employer, you as a nonprofit, or to the government about an act or omission that he or she reasonably believes violates the Affordable Care Act. Look at this. Look at the breadth of this. It covers both actual complaints and potential complaints. An employee doesn't even have to complain to be protected. The complaint doesn't need to be in writing. Okay? And even more, the complaint doesn't even have to be correct. The employee can be totally wrong about what they're complaining about, and they're still protected. The third category is fairly large too. This is the opposition clause. It prohibits retaliation against an employee because they have either objected to or refused to participate in any activity or task that they reasonably believe violates the Affordable Care Act. This primarily will deal with supervisors and human resources professionals. Okay, part two. We know what protected activity is. What retaliation is prohibited in response to protected activity? And you can see, as you know, the law is teeny. So it says an employer cannot retaliate, discriminate against an employee in any manner with respect to his or her terms and conditions of employment. Now, what does that mean? Terms, conditions, and privileges of employment. Well, it means virtually everything. okay? The easy parts of prohibited retaliation are the first 5 bullets or so. If an employee engages in protected activity, they can't be fired, they can't be demoted, they can't receive a negative performance evaluation, you can't discipline them, you can't negatively affect their compensation and benefits because of the protected activity. But as you can see, it also covers very subjective acts such as blacklisting, denial of opportunities, threats, intimidation, okay? Those are very difficult to defend against. I mean, if an employee says, yes, because I complained about the health care plan, my boss started intimidating me. Under federal law, that is now a cause of action that gets them to go to court. The bar is very low, and I suspect that there is going to be a great deal of lawsuits against organizations under this. Now, as I said, does anything go for protected activity? We talked about that the complaint doesn't need to be accurate, reasonable belief is enough. Another thing I often see in retaliation whistleblower claims is the person comes forward and they're not really trying to change things for the better. They're usually doing it to either get someone else in trouble or to protect themselves. It's like the first example. In order to avoid being terminated for poor performance, they complain, okay? Under this law, those are not necessarily defenses, okay? Someone can be protected even though they are motivated by blowing the whistle to save their own skin. Okay? Now, we're going to shift gears a little bit and talk about something really nasty that may impact those of you who are kind of on the bubble of being a large employer or not. Okay? And as you know from the previous presentations, depending on whether you're a large employer, you could be subject to the A awful penalty or the B bad penalty, okay? We'll come up with a better word, I'm sure. So given that, there are some easy solutions, and I know what you all are thinking. I can hear you, okay? You say, well, gee, since 50 is the magic number, let's just reduce our workforce just to 49 or so, and that way we're not covered, right? Seems easy. Or, how about this? Why don't we cut some employees' hours? Yeah, so they're just nudge them below 30 hours a week so they're part-time and you don't have to offer them coverage. Or, I know, let's convert some of our employees to independent contractors because independent contractors are not employees and therefore don't have to get coverage. So those are obviously easy solutions, right? Wrong. There are very dangerous risks involved with those potential solutions. The first one comes under ERISA. It's the federal law has been around for quite a long time dealing with employee benefits. And within ERISA is what's called Section 510. It's the retaliation provision, whistleblower provision. And it prohibits nonprofits and other employers from terminating or taking adverse action against an employee because they've exercised rights under ERISA. So the cleanest one is if you have someone who files a claim that costs the plan a lot of money and you fire them because of that, or you fire them right before the pension is going to vest. Those are classic causes of action. But there's also within there a prohibition of taking action against an employee who interfere with their attainment to benefits they may become eligible for in the future. What that does is it potentially covers reductions in employees' hours or changes in their classification that result in their disqualification from participating in your plan. The Affordable Care Act has a similar provision, although it operates a little bit differently. It prohibits an employer from retaliating against an employee because they received a subsidy or tax credit through one of the exchanges that Chris was talking about. So therefore, if you reduce an employee's hours in response to the receipt of a tax credit or subsidy, the Affordable Care Act will give them a cause of action. Okay, the statutes also have, as I said, some very sharp fangs, dripping with poison, enforcement proceedings. You can be sued in court. There is a very low burden of proof for your employees in order to prevail. And although you have defenses, they're very high defenses to meet. The highest higher than what you have in Title VII or the Americans with Disabilities Act or the Age Discrimination Act or even most state laws. Jury trials are available, and we all know that jurors love employers, so you don't have to worry about that. And as I indicated, there are broad remedies. A lot of money can go in the pockets of a person who prevails. So let's close out by talking about some risk avoidance. So number one is know where the tripwires are, and hopefully we've identified some of them. Another risk avoidance tool is limit the employee's argument that there was a specific intent to deny them benefits when you're making an adverse employment action, okay, when you're either denying a promotion or a termination or discipline. And you, of course, do that by documenting legitimate reasons for the decisions, okay? Update your handbooks and job descriptions so that the full-time and part-time dichotomy is well-defined. If you haven't looked at them in a while, dust them off and do it. A lot of times, job descriptions are second-class citizens in the world of employment law. So bring them to the table and talk to them a little bit. Some of our clients are grandfathering their existing workforce and bringing in new folks under the new part-time, bringing them as part-time rather than shifting current employees to part-time. Next is manage your communications regarding changes in your benefits and changing in your staffing decisions. Nothing is worse than having an email going around that says, yeah, we are going to reduce headcount so that we don't have to be a large employer, or we're going to reduce hours so we don't have to offer benefits. I mean, it sounds like a common sense thing to do, but it will make our job so much more difficult. And lastly, audit independent contractor relationships. The IRS loves going after nonprofits and other employers that have misclassified employees and independent contractors. If you have independent contractors, particularly those that have been around for a while, there often is slippage in the relationship that makes them go more towards being an employee. And if that's the case, they're potentially covered under the law, and you have to make some determinations with respect to benefits. Thank you.
Thank you, Todd. On my clock, we have about 10 minutes for questions. I have some folks have posed on the webinar during the program. But why don't we start here with folks in the room. Anyone have any questions for any of our speakers? Just hold on a second. Marion's coming up with the microphone. And try to speak as loudly as you can for the benefit of those on the phone.
When you have is this on?
Yep. Yes.
When you have the 90.5% rule on affordability, is it permissible to have a variable rate for the same coverage? In other words, you have somebody who's been around for a long time and they do the office cleaning and things and they're close to minimum wage, and you say, for you, it's free, so therefore it has to be affordable. Then are you open to all your other employees saying, I want the same deal, or is there some wiggle room there?
That's an excellent question, and generally speaking, you are free to discriminate in favor of the non-highly compensated, at least from a tax perspective. That's a little bit of a loaded statement as who's non-highly compensated. If you are a self-insured plan, it's everybody outside the 25% highest paid. If you're fully insured, we don't have discrimination rules, but they are coming shortly, except for rules under a cafeteria plan that allow pre-tax. But generally speaking, the fact that you're going to charge less highly compensated, less of a premium, is fine from a tax perspective.
Yeah, and I'll just layer on that, really to simplify it, the non-discrimination rules, you say you can't give higher contributions or benefits to a highly paid individual. If this particular individual or your particular employees happen to be lower paid, you can give them as much money as you want to the detriment of your higher pays. So you can discriminate in favor of lower paid workers. to, for example, meet the 9.5% threshold?
In my world, the large print giveth and the small print taketh away. And here's the small print. Whenever you are treating different employees differently in terms of compensation and benefits, it is going to potentially create morale problems. But if they can identify that these differences in treatment are due to protected classifications, they can have a cause of action.
Thank you. I'm going to pose a few quick questions from the webinar if you guys can try to answer quickly so we can get through a number of these. A couple reporting questions probably for Harry. Is Form 1095-C only for employers with self-insurance or all types of insurance?
The 1095-C is for, regardless of whether it's self-funded or insured. If you're self-funded, there's an additional section that has to be completed.
Okay, and Harry, another question. As a self-insured employer that is sponsored to a VIVA, pension, or 403B plan, would the sponsor be required to file a control group 1094-C tax filing?
That one we probably have to take offline and get more facts about what's background there.
Okay, to the gentleman who posed the question, feel free to follow up with Harry directly. His contact information is on the screen right there. Todd, this is a question for you. What should employers do when they are reducing employee hours, not to evade large employer status or penalties or the employer mandate, but actually because program and department cuts are necessary?
Make sure that they have gone through a protocol to vet the reasons and that they are substantiated by business reasons and defendable.
Yeah, and obviously that same basic guidance applies anytime you're having a reduction in force or cutting employees' hours or taking any other adverse action against employees. Another question, is there a preferred method of notification to employees of benefit eligibility?
I don't think there is a preferred method, but you want to be able to track the fact that you've done that. For the very first time, that becomes very important documentation. Now, there's no prescription as to what that needs to look like. It can be as simple as having somebody testify if need be. This is our processes, and this is how I know I got the offer out. It would be better if you were, for example, doing electronic enrollment, that you actually had the person decline that they did not want coverage.
Okay, questions here in the room?
For the control group...
Can you try to speak as loudly as you can?
Sure. For the control group, does that include foreign enterprises? We have a wholly foreign-owned entity in China. Would they be included in the control group?
My reaction is no. There seems to be kind of crossing between whether a foreign entity has to offer coverage and is subject to many of the rules under the ACA.
I'd actually have to crack the code and look at it,
yeah,
and the regulations, which we can do. Yeah.
Yeah, and it is a great question because an increasing...
it could be more complicated than sounds. But
an increasing number of our nonprofit clients, very increasingly, in fact, we deal with these issues every day, it seems like, have opened various overseas offices by setting up separate legal entities, oftentimes because that's what's required by local law. Sometimes they may be employees of the U.S. nonprofit corporation, oftentimes, though, they're not. And so the answer to this question may be in part dependent on those issues, which are going to vary very specifically from country to country and organization to organization.
And there may be a difference between counting to 50 and then who has to get the offer of coverage.
It's a great question, though. Other questions here in the room? Okay, hearing none, let me see if we have any more questions from the webinar. Similar question. Do all of these healthcare laws and regulations apply in the same way to all states in the U.S., or do they vary?
My response is that it's a federal law, and thus it applies uniformly among all the states. Now, when it comes to insurance law, that's a little bit different because some, especially in the fully insured context, a plan is oftentimes subject to the insurance laws of that particular state, so thus you do not have uniformity. But when it comes to these tax rules, which at the end of the day is what these are, i.e. the employer mandates under 4980H of the Internal Revenue Code, the reporting requirements live under 6056 and 6055 of the Internal Revenue Code, that, in my opinion, and I don't know, correct me if I'm wrong, it would apply, the answer would be it applies uniformly.
Okay, thank you, Chris. Thank you to our panelists for a terrific presentation and for getting everything squeezed in the allotted time. We really appreciate it. We will continue at Venable to, of course, stay on top of all of these issues and continue to put out alerts and other guidance on the topic, and I'm sure we'll see you back next year for another webinar on something healthcare reform related. Otherwise, hope you can join us next month for our monthly program. Thank you very much for coming and participating. Have a good afternoon.